remember back to like 2004, 2005? You remember that back that far? Mm-hmm. And, you know, the housing market was sort of going and everything's going great. Everybody should buy a house, right? And they had these great little loans that they were offering people, you know.
Very low rates.
Really low rates. Oh, you want to get this one. This will be great. Well, oftentimes those loans made to buyers called subprime buyers because their credit history is a little iffy. All right. These kind of loans, they began with a teaser rate that would cover you for 2 or 3 years. And then that would switch. It would adjust to a longer-term market rate, okay? An adjustable rate mortgage, an ARM, that's what we call it. So now it's later, and those 2 to 3 year teaser rates, they're going by. So if you do the calculation, for the next part of the year, over 2 million mortgages, these are just individual mortgages, are going to reset. That represents anywhere between $600 billion to $1 trillion.
And they're going to reset and not at just a tiny increment. This could be significant. I was reading up to 35%.
Yeah, that's right. I mean, it's a huge amount of resets that are going to go on, and you're going to feel the rumble. Now, here, let's put it on a consumer level, okay? I think we've got a little example that we can throw up for people, all right? Say you got one of these teaser rate loans for a $200,000 mortgage, okay? That 2/28, that means for 2 years you have the teaser rate, and then it'll adjust, and for the next 28 years, you're doing the market rate, okay? Now, say it was a 4% teaser rate for those 2 years, which wasn't unusual back then, right? It was, hey, money's cheap, all right? Look at what that's going to do to your mortgage payment per month, okay? You went from about between $900 and $1,000 a month, all of a sudden becomes $1,331 a month. And for some people, that's a pretty hefty chunk of change to all of a sudden be changing on your mortgage payment, right?
Something's got to give there.
Something's got to give, and a lot of times what happens, since, you know, this is kind of people maybe living on the edge, you know, paycheck to paycheck, bill to bill, they're going to have to foreclose on their house, all right? So you see all those foreclosures spiking up all over the country. It's likely to happen in places that had big property run-ups or have certain industry problems going on. So you're looking at places like Nevada, Florida, they've had big industry run-ups. California, big real estate industry run-ups, okay? Or you get places like Massachusetts, maybe some parts of Ohio, where industry has been a little bit depressed. Those are where you're going to see the foreclosure spikes.
And then even in a state like Georgia, where we haven't necessarily seen the huge spikes, we've had steady growth over the last decade or so, but we do have one of the highest foreclosure rates in the country.
You do, because, you know, and I flew down there to visit the, you know, the mothership not too long ago, and we were up circling in the plane and looking down at the airport, and all the developments you have down there where, you know, somebody went in, they speculated, they bought a lot of land, okay, it was a builder type, they built a couple houses saying, hey, I'm going to hope that this market stays solid, and then all of a sudden it didn't stay solid, and so you're seeing a lot of half-completed developments down there where they just can't sell the houses, and now a lot of people can't make the payments, and so the foreclosure rate's going up. Now, this isn't just going to be isolated to, if people are out there in TV video land saying, well, that's not going to affect me, I'm a prime borrower, I got a 30 rate fixed, I'm fine and everything, and my portfolio is doing well. Don't count on it. All right, because they took all those subprime loans and they divided them up into little slices and they put them into little bonds and collateralized debt obligations and all sorts of fancy sounding securities. And basically your bank that did the mortgage sold that off as a security to a bunch of institutions and pension funds and maybe a few hedge funds here and there. So you don't really know who's holding the bag on all those mortgages. If the mortgages go sour, those securities are going to go sour too. And all of a sudden you're going to be shocked to look, why, that bond fund I invested in, suddenly it's tanking. Why is that? Because of exactly this situation we're talking about.
So the markets could really take a hit, but anybody who secured a 30-year fixed has no reason to worry at this point.
At this point, no, but you never want to see the market get unsettled, okay? You never want to see a lot of mortgage hanky-panky going, because remember, foreclosures are going to hit everybody's property value, okay? That means your local government isn't collecting enough property taxes, so you know, can't support the services that you come to rely on. Nobody wants to buy a house or value a property highly if they see boarded up house on the block or something like that.
Alan, we are almost out of time, but I want to focus on one other topic because it's a ripple effect within the economy. That's Home Depot now reporting, and Lowe's Lowe's reporting and Home Depot cutting its 2007 profit outlook. It's the ripple effect from what we've just been talking about.
Yeah, exactly. This morning they cut it down. Analysts were expecting them to make about $2.59 a share or thereabouts. Home Depot said, hey guys, you got to revise that. We're looking at more like $2.30, maybe up to $2.36 a share. So that, that Wall Street goes, oh no, they're cutting down their earnings outlook, and you're going to see a down market today. I think it's already probably opened down, and while we've been talking, and that's exactly what you're talking about, Melissa. That ripple effect is just you're going to see it in every business that is tied to the housing market is going to see some sort of downturn.